Good morning and welcome to Outlook for Venture Capital. This is Roger Royce. I'm the founder of the Royce Law Firm, a business, tax, and corporate law firm with offices in Northern and Southern California. Today's presentation is Outlook for Venture Capital by Terry Moore of Moore Venture Partners, LP. We're going to have an informative webinar on VC investing and Moore Venture Partners model for success. Terry will be discussing the outlook for venture capital investing, why now is a good time to invest, and about Moore Ventures' VC fund model for successful investing in today's economic climate. A couple of housekeeping matters. In the upper right-hand corner of your computer screen, you'll see a dialog box where you can add questions or comments, and we'll collect those, and hopefully we'll be able to answer those at the end of the webinar. Secondly, the materials here today and the webinar will all be saved on Royce Law's YouTube site as well as the Royce University webinar site. So with that, I'd like to turn it over to Terry for the presentation. Terry, are you there? So while we're waiting for Terry to come online, I'll just mention that the webinar, this is one in a series of webinars that Royce Law Firm puts on almost every week. Our latest webinar that you might have tuned into was very similar. It was on accelerators and incubators. We had a panel of 7 founders or promoters of various accelerators and incubators in Northern and Southern California discussing how their programs will help startup companies form companies and also obtain not only venture capital but also mentor capital. Our next webinars that we're going to be having coming up will be on sustainable investing. Hello, Terry. Welcome, Terry Moore. Are you ready to present?
Yes, absolutely. Yeah, thank you for that kind introduction, Roger. So with that, I'd like to begin a presentation on the outlook for venture capital. I'm the managing partner and founder of Moore Venture Partners and the chairman and founder of the VC Roundtable of Southern California. The Moore Venture Partners is an early growth and expansion stage investor in our top tech and life sciences companies. What's unique about what we do is we only invest with top-tier venture capitalists and top corporate investors. And the VC Roundtable is a monthly luncheon now in its 12th year with investors, angels, institutional VCs, and corporate investors to talk about our deals and talk about our funds for syndication and partnering purposes. And it's held in San Diego on the second Wednesday of each month typically. Anyone's interested, please feel free to contact me by email or phone. Let me know if you're interested in attending. So let me go on with the presentation and talk more about the outlook and Moore Venture Partners model for success for investing in the current environment. So during the presentation, I'll give an overview and highlights on the industry. We've just incorporated the latest 2012 numbers, and so we'll provide a status on the industry, the fact that the venture capital industry is going through a restructuring or right-sizing, and where the money is going by stage, sector, and region of the country. The liquidity environment for exits, primarily through M&A and IPO, summary of the trends, what does it all mean and where are we headed, planning for success in the future, and a summary of new models that include Moore Venture Partners model for success. So with that, I'll begin with the industry overview. For those of you who are not as familiar with venture capital, I'll give you a little overview on what venture capital is. Venture capital is primarily financial capital provided to high potential, high risk, high growth companies that are typically technology or healthcare, life sciences, or clean tech related. Not necessarily, but typically. And private equity funds are leveraged buyout or management buyout funds, typically much larger and aren't technology or biotechnology or healthcare focused. And so venture capital typically invests in the Series A, B, or C preferred equity rounds of these companies and at least that's what More Venture Partners' focus is. And we hold this preferred stock until exit. So these are small private companies, hopefully growing rapidly, that will either sell through M&A or go public. And so venture capital is a subset and a much smaller, about 10th the size of private equity, which is also similar in owning the private stock of companies or in taking companies private or being taken over by the management or alternative investors. So that's venture capital. The investment activity for 2012 includes $26.5 billion being invested in 2012, and that's a small decline from 2011. And that far exceeds the amount of capital that was raised by venture capital firms, and I'll talk more about that in a minute. 3,698 deals were funded in 2012, and that's a small decline of 6% compared to 2011. And there's a number of reasons for that I'll go into in a minute. Seed stage investments fell even further than last year, which was down by about 50%, now down 58% in terms of dollars only, not number of deals, compared to 2011. And software and IT is still the dominant sector for investing. On the exit side, the highlights for 2012 include 435 venture-backed M&A deals in 2012 that were sold at a disclosed value of approximately $21.5 billion. And that's a small decrease of about 10% from 2011. And there were 49 venture-backed exits via IPO in 2012, and those were also valued at approximately $21.5 billion. And that was a 110% increase from 2011, mainly on the value of Facebook's IPO, which was very strong as far as dollars raised, not in the performance from the public offering. Fund commitments for 2012 were about $20.6 billion. That's the amount of money that venture capital funds raised from their investors, the institutional LPs that invest in venture capital funds, and approximately 182 VC funds were raised in 2012. And this is an increase of about 10% from 2011, which is positive, but it's down substantially from the mid-2000s. In fact, 33% decrease in the amount of venture capital raised since 2007, and even more from the mid-2000s, in which the mid-30s or almost $40 billion were raised, and back to 2000 when $100 billion was raised. So you can see we're really bottoming out in 2010 with $13.8 billion being raised by venture capital funds, and in 2009, $16.4 billion, and then in 2011, $18.7 billion, and a slight increase of about 10% to a little over $20 billion in 2012. So we're increasing the amount of funds raised, but venture capital funds have been making far more investments than they've raised. And so typically venture capital funds invest for the first 3 to 4 years of a fund's life and then reserve the follow-on capital for their existing portfolio companies for follow-on investments. And they typically don't make any new investments, at least early-stage investments. They may make later-stage investments after year 4 or so of the typical 10-year fund. So what we're seeing is the least amount of capital that's been raised by venture capital funds in almost 20 years over the last several years as the industry right-sizes and restructures. Going on to the next slide, which is 2012 venture capital investments. You can see that slight decrease in 2012 from the previous 2 years of increases from 2009 of $20.4 billion. This is the amount of capital that venture capitalists invest in deals, and then in the yellow graph bars, the number of deals. So approximately 3,700 deals, which is slightly down from 2011's 3,937 deals. This is still well below, as I mentioned, the early 2000s, when far more capital was being invested in our companies, and one of the reasons why it's so difficult to raise venture capital these days. So the next slide is 2012 increased funds raised. So we are raising more capital, slightly more, from the bottom of 2010, when $13.7 billion was raised by venture capital funds. This is a positive trend, but it's not nearly enough capital for the amount of investments that we've been making over the last 3 or 4 years. So this underhang I'll talk more about, which is the amount of capital that's been invested that far exceeds the amount of capital that's been raised. And you can only do that for so long. And we've been doing that for 3 or 4 years, which is about the amount of time that venture funds make new investments. So something has to happen. You're going to hit a wall. Fewer investments have to be made. And I think that's why you're seeing that trend on the previous slide of slightly 10% or so less investments being made in dollars and the number of deals, because the small amount of venture capital that's been raised versus the larger amount of capital that's been invested. So that's the trend. We're seeing slight upticks, which is positive in the amount of funds being raised, but it's still not enough to address the underhang, the amount of capital that's been invested that far exceeds the amount of money that's been raised by venture capital funds. So the next slide is the industry status, and this is the restructuring I was talking to or referring to earlier. Too many venture capital funds were raised in the mid-2000s and going back to the year 2000 when $100 billion was raised by venture capital funds. And so that was too much capital chasing too few good deals. Now the pendulum has swung to the other side of the spectrum, and we've seen too little capital raised by venture capital funds to invest in our startup companies. And so the reason why is the venture capital industry as an asset class has underperformed for a number of years now, and the big institutional LPs are not interested in venture capital. So the big pension funds, the big endowments, et cetera, have not been investing in a big way in venture capital until such time as they see the asset class start to return investments. And we're just beginning to see smaller funds like More Venture Partners starting to return venture rates of return from the latest venture capital funds in the current environment. So that's why less capital has been raised by VC funds. The funds that were raised in the early 2000s and mid-2000s that have not returned investor capital are struggling to raise new funds. They haven't had the liquidity events from their existing portfolio companies to return that capital to their limited partners or investors so that those new partners or those partners want to invest in their new funds. And that's made the environment particularly difficult for entrepreneurs and startup companies who are struggling to raise new capital for their companies as well. So that's the challenge. The exit environment has been improving, but slowly. We saw a little, a little trend down again in M&A and IPO last year. There was a number of things. It was election year. There was a lot of uncertainty. We had the fiscal cliff and all these things that raised uncertainty and prevented the M&A and IPO exit environment from being as strong as we would have liked. The more exits we have, the more liquidity events, the more that cash goes back to investors, and the more those investors feel like they want to make new investments in new venture capital funds. So when the exit environment continues to improve, we've had a great start to this year with the number of IPOs, and so we feel like this could be a strong year for exits, and that could provide more liquidity, allowing venture capital funds to raise more capital to invest in our next companies. So we're excited that the potential is there for raising more capital this year. And if those funds that haven't returned investor capital that will struggle to raise new funds, those funds will continue to go away if they haven't returned investors' capital. And that's what we're seeing in underserved regions of the country, like Southern California, where More Venture Partners is located, in San Diego, where we're focused on the underserved by venture capital region of Southern California, and other regions, predominantly any region outside of Silicon Valley where most of the venture capital resides. Next slide is where the money is going. So you can look on a year-over-year basis for the last 3 years compared to 2010 and 2011, the stage of investing, and this is where that substantial decrease in seed capital is occurring. And so we've seen a decrease in 2012 from the prior years, 2010 and 2011, and that's a challenge for us because those entrepreneurs with their startups are struggling to raise those angel rounds and seed rounds of capital. And whereas the early stage we've seen slight decreases, and expansion even more modest decreases, and so those areas are still receiving funding, but not as much as the seed stage, where there's really struggling, far more amount of decrease in seed stage investing in 2012 compared to the prior years. The next slide is investments by industry, and so that's where software and IT, you can see 2012 even exceeded 2011, and it was the only industry sector with year-over-year growth. And so that's where we're seeing most of the investments dollars going these days. Biotechnology, which has struggled over the last several years, is down the amount of investments in 2012 versus 2011, but it is still the second largest investment sector. And we're seeing quite a decline in energy, so industrial and energy segments or sectors. 2012 had a significant pullback in the amount of investment in that sector as well. Next slide is the valley is still game on. So by region of the country, this is what I was just referring to, a majority of that capital resides in Silicon Valley, which is why I spend quite a bit of time up there. In fact, I'm in Palo Alto, Menlo Park tomorrow for meetings. And San Diego is down. We've had an uptick in 2012 from 2011, but you can see as a region, it's well below Silicon Valley and New York Metro and New England, and even LA and Orange County as other regions of the country. And so Silicon Valley still is strong, even though it's slightly down from 2011. It's still the place to go for venture capital. And San Diego has actually slipped behind the Midwest, which isn't positive. San Diego and Orange County are extremely underserved by venture capital. It's quite acute these days from local venture capital. Most of the capital, 95 to 98% or more, comes from outside the region to fund our companies in San Diego and Orange County, Southern California. So the next slide is Silicon Valley dominates, and you can see the amount of capital, the over $10.9 billion that is the amount of capital that Silicon Valley has to invest or invested last year in 2012 versus other regions like New England, $3.2 billion, the New York metro area, $2.3 billion, and then LA and Orange County in fourth at $2 billion. San Diego at 6 as an area, $1.1 billion, and fallen below the Midwest. Lumped together in the bottom ranking, you can see San Diego with LA and Orange County is third, but we've slipped below New England. And in 5-7 years ago, depending upon the size of the deals and the number of deals, Southern California exceeded New England as the number 2 region. And so we can see we're in third place at this point, slightly below New England. Next slide is liquidity in the exit environment. It's par, as I mentioned earlier, the amount of M&A exits versus venture-backed IPOs for 2012 pegged at that $21.5 billion or so in disclosed exit values. And that's quite an improvement in IPOs, primarily because of the big Facebook and Zynga and Groupon IPOs. The amount of dollars raised in those IPOs. It brought the IPO amount in 2012 well up. You can see the M&A amount was slightly down from 2011, but it did exceed the M&A values from 2010. And I think we'll continue to see that trend of M&A values continuing to increase from the earlier years of 2008 and 2009 and even 2010 as we go forward. As the large Fortune 1000 or Global 1000 companies that have cut their balance sheets to the bone, their employees and so forth will need to buy their innovation and will be more in a purchase or acquisition mode for their next generation of innovation. And that's what we're hoping for with our portfolio companies. So the exits, M&A versus IPO, if we went back even further, I think you'd see 2007 was a good year, and then even 2004 was a pretty good year for IPOs. I think they were in the 90s number of IPOs in 2007 and similarly in 2004. But again, we expect the M&A to be the predominant exit mode, and 49 IPOs were the number for 2012, down slightly from the 51 venture-backed IPOs in 2011. And 68 in 2010. So we're not, expecting the IPO window up to open a strong way. It's very difficult to take a company public, take strong revenues and stable earnings growth, and companies, on trajectories to do 200 million or more or so can afford the cost, the regulatory costs and others to take their company public. So M&A is a predominant form of exit. And that number was 435 disclosed deals were exited through M&A in 2012. The next slide is a summary of trends. And so what we're seeing is the exit environment, particularly if you go back a few more years, seeming to be on a rebound, primarily through M&A. And as those exit valuations, continue to climb, that's a positive thing because companies that were selling are selling for greater and greater prices from the bottom feeder days in 08 and 09 when companies had to sell and they took, there were a lot of bottom feeders acquiring these companies for very low prices. And so we're climbing off of that bottom into more and more reasonable valuations for our M&A exits and even some premium prices for our M&A exits in some cases. And then this concern about underhang in the VC industry I talked about before, which is really the fact over the last 3 or 4 years now, the venture capital industry has invested more money into companies than the venture capital firms themselves have raised. And so you can't do that for very long before you hit a wall. And that's where we are today. And that's why I think more capital has to be raised for investing or fewer deals are going to be done. And that's kind of what's happening. We saw that slight decrease in the amount of capital invested in 2012. And I think we'll kind of see a combination of that. I think we'll see slightly more capital raised by venture capital funds this year, and we may see flat or slightly down amounts of capital invested, depending upon how much capital is raised. And fundraising is now becoming easier for not just entrepreneurs, but also for VCs. So if they don't have strong track records, a number of liquidity events, and strong performance for and track records for their funds, those existing LPs and new LPs won't be coming into their next funds. And many of these funds that haven't performed will be going away in the years ahead. So if a fund hasn't raised a new venture capital fund in 6, 7, 8 years, then they're struggling to raise their follow-on funds, and it may be challenging for them to raise their next fund. So we'll see more funds going away. We're down to about half or so the number of funds that we had 6 to 12 years ago. And so this is the restructuring I was talking about in the industry, as funds that haven't performed are going away or facing challenges raising their next funds. The cloud-based companies and the SaaS models are strong. Mobile and healthcare IT are also seeing strong support from the venture capital community, and a number of those deals are getting funded. And it's parallel to the exit environment through M&A or IPO. We're seeing a similar trajectory and the markets for those companies are doing very well. California dominates because of Silicon Valley with the amount of capital. And Southern California, predominantly San Diego and Orange County, there's a little more capital in Santa Monica and Century City and LA, but not a lot more. As a region, almost 30 million people from Santa Barbara to San Diego is slipping in the amount of dollars and number of deals. And that's from local capital predominantly, because most of the capital to fund those companies in that region is coming from Silicon Valley and back east. So the next slide is, where are we headed? And so what we're seeing is a limited number of VC firms will be able to successfully raise new funds. And those are predominantly the big brand name funds, the top tier funds that will always be able to raise new funds and typically have the largest fund sizes. So 80–90% of the capital that's raised is raised by the top 10, 15 venture capital funds. And then the rest of the funds are much smaller funds. And that's because the institutional LPs are still waiting for the venture capital class to return capital, and a venture rate of return, 5 points or more so on the S&P 500 or so is typically the minimum for a venture rate of return. Fund sizes will typically be smaller. So there's a Kaufman study last year about the fund returns versus fund size, and they're saying an optimal venture capital fund size is 35 million or so, and certainly the funds 75 million or less seem to be performing much better than the multi-$100 million size or $500 million size funds. And the reasons for that are obvious. There's $500 million or $1 billion size venture capital funds need to have $1 billion exits, and there just aren't that many of those to return those size funds. And the much smaller funds, that model works well, where venture capital funds are investing several $million and getting sizable stakes, 20-25% of a company in the early stages, and then they're able to exit those companies for multiples that work for those size funds, and selling those companies for $100 million or several hundred million are very, very nice returns for those venture capital funds. And that's why we're seeing fund sizes typically be smaller, and also because of the challenge of raising capital. It's very difficult to raise venture capital funds these days. And so those models are working well, and so I think we'll continue to see typically smaller funds. If you think back 15 or 20 years ago, venture capital funds were typically 50 to 75 million, and a large venture capital fund was 100 million in the early 90s. And so I think we're going to return to something similar to that, maybe not quite as small, but certainly smaller fund sizes, particularly in the IT sector where those companies are more capital efficient and require less capital to get to profitability and exit. So back to traditional fund models and brand name funds, and that's who More Venture Partners partners with, those top tier funds that will always raise new funds and won't struggle to raise follow-on funds. They're great investors, and the corporate investors who are investing more today than ever. In fact, I'll be at a reception for the IBF Corporate Venturing Conference in Newport Beach this evening that kicks off a 3-day conference of the corporate investors, which is a wonderful source of capital for early stage companies these days. So there's an opportunity to leverage with these top funds and to focus on less capital intensive deals and earlier exits. That's what the investors want, to see exits in reasonable time frames. 3 to 5 years or 6 years is a long time to wait, and so no one wants to wait 7, 8, 10 years for an exit. And so if you can exit your portfolio companies in 3 to 5 years, that makes a lot of sense. And VCs can't be lazy. They've got to roll up their sleeves and add real value to their companies. And that's what you've got to do to be successful and have great companies and great returns. And we'll focus on the most innovative and capital efficient companies these days because that's where it makes sense for those earlier exits. And we'll focus on talented, been there, done it before management teams. So ones that have been tried and true and know how to create successful exits and have a track record of success. So in planning for success, the next slide, as we go forward, new fund strategies and models will be developed, particularly to focus on these underserved regions, which are predominantly most of the regions outside of Silicon Valley. And those new models and fund strategies will identify the top investment opportunities either in their region or in other areas and add value early and help those companies grow until exit. And they'll focus on early because that's where the returns are. If you look back historically, the best returns for venture capital have always been in the early and growth stages, and that sweet spot makes a lot of sense, the Series A and B and C rounds. And they'll focus on great products. They're solving real-world problems, global problems, in fact, and bottlenecks, and very talented management teams with deep industry experience and expertise to take those companies all the way to exit. And they'll leverage relationships with the top VCs and corporate investors for partnering and for leading and acquiring those companies. And VCs must perform. So they've got to source these top deals no matter where they are. They've got to add value, and they've got to exit them at the right time, providing real rates of venture return. And we haven't seen that for some time now. And of course, the liquidity, the exit environment has been challenged, and we think that improvement in that over the next several years will allow us to have more distributions and more liquidity and allow us to raise more capital to be able to invest in more companies. And improved performance over the next several years will allow more institutional LPs to return to venture capital because of the higher return potential. And we're starting to see that. We're seeing smaller funds returning 4, 5, 6x in the current market environment, the current economic conditions, because there is such a limited amount of capital to invest. Only the very best deals are getting funded. And those companies are selling at very nice multiples, which are some very nice returns for investors in venture capital in the current environment. And we'll continue to see that over the next several years, and we think the industry will have an outperformance because it is such a macro-cyclical industry over the next 5 to 10 years. We're very bullish on that. So in summary, the industry is not broken. You've heard that maybe from some folks and maybe from partners where their funds haven't performed. They're saying the industry's broken. But it is going through a restructuring and a right-sizing. So the right amount of capital being raised by those funds to invest in our top tech and life sciences companies at those early stages. And so we're figuring that out now. It's slightly over $20 billion was raised last year, and that may be the right number, or maybe slightly higher than that in the 20s billion raised, and in the 20-some billion invested annually may be the right number. But we'll see as we go forward in the years ahead. And the VC funds that have not performed will not be able to raise new funds. They haven't returned their investors' capital, and they'll be going away. So if you're talking to a venture capital fund that hasn't raised a new fund in the last several years, 2, 3, 4 years, they probably don't have new capital to invest in any new opportunities. So be careful of the funds you're talking to. Make sure they've raised a new fund within the last 4 years or so, and that they are making new investments. And the brand name VC funds, the top tier funds, will always raise new funds, and they have performed for the most part. And those are great partners to have, and that's who More Venture Partners partners with. Companies seeking venture capital will have an even tougher time ahead, again, because of this limited amount of capital that's available, the constraint of venture capital, and this underhang I talked about, more capital being invested than raised over the last 2 or 4 years, which is now approaching $30 billion or so, this underhang. And that's quite substantial. That's more than what we have raised and invested over the last several years. So the improved exit environment will help. More liquidity events will help turn the industry around, and it might take several more years. And we'll have to wait till the institutional LPs start to see that rebound in venture capital returns that we're starting to see on a quarterly basis now with smaller funds like More Venture Partners. New VC funds and models will appear like More Venture Partners, and this provides an exciting time and a great opportunity for investors to get in at the bottom of this cycle where we're bouncing along with the limited and constrained amount of capital in venture, but only the very best deals getting funded, and the opportunity for those companies that have gotten funded by venture over the last couple of years being able to create real value over the next several years and being worth a lot more than when we invested in the next 3 to 5 years. And so it's a great opportunity to get in the bottom now and invest in these top companies and sell them in a few years for a lot more than what we've invested or what at the price that we invested, and to ride this industry back up again over the next several years. So now More Venture Partners. What is it about More Venture Partners that makes us unique and innovative? Well, I've spent the last 15 to 20 years building great relationships with the top VC funds, and what we do is leverage my relationships with those top funds to bring their deep pockets and their reputations and their top funds to our top projects, our top tech and life sciences companies. And we do that at the early growth and expansion stages and across sectors. So we're diversified, very diversified across tech and healthcare, life sciences, med tech, and clean tech. We want to do the very best deals in those sectors. And there's a lot of reasons for that diversification. If you're so narrowly focused that those companies in that sector, if they're in a down cycle 3 to 5 years after you invest in them, then it's hard to exit those companies at a premium and make your fund and raise a new venture capital fund, because you've got to ride out the cycle and wait for those companies to rebound so that you can exit them at a valuation that will allow you to return your investors' capital with a venture rate of return. With a diversified portfolio, typically tech and life sciences are contracyclical, and you can always exit portfolio companies at a premium, have an outperformance for your fund, have a great return for your investors, and go raise the next fund. And that's one of the many reasons. Plus, it's also what we do well here in San Diego and Orange County in Southern California. These are the top sectors for investing. We want to take advantage of the very best deals in those two diverse sectors. And so we really focus on underserved regions like Southern California, where there's a limited amount of venture capital, and where we can bring our top VC funds and top corporate investors to our very best tech and life sciences companies. We started in 2010. We made our first investment in a diagnostic company, Astute Medical. So the fund is a very diversified by stage and sector fund, headquartered in San Diego. We do source and qualify top deals from all over. About 2/3 of my deal flow is from Southern California. The other 1/3 or a couple hundred companies come from Northern California and back east. And we've made 4 investments to date, and we're about to make our 5th investment. And this first fund that I've done on my own, my 3rd venture capital fund, will close on April 9th of 2013, so just a little less than 2 months' time. And then later this year, we'll begin to work on More Venture Partners Fund 2, which will be a much larger fund. I look at 400, 500, 600 deals a year, and I've built that deal flow up over the last 20 years. And I only focus on 6 to 12 companies a year that really look truly top-tier venture backable. So the deal flow and syndication comes from a number of sources, but I set a real high bar for very high-quality companies that look truly top-tier venture backable, because it is very difficult to raise venture capital. You have to have a very talented management team. You have to be big opportunities, solving big problems. They typically have to have great intellectual property. And so these are some of the things we look for: very talented management teams, deep domain expertise, etc. And of those 6 to 12 companies I focus on per year, if 1 to 4 receives a top-tier VC term sheet, then I decide if I like the price and terms and am able to carve out room in the transaction, since I've brought the deal to the top VCs and top corporate investors. And I only need to invest in 1 to 4 deals per year to create a great portfolio for More Venture Partners. And so I source these deals, I do preliminary screening, I do very detailed due diligence, I rely on patent attorneys, they're advisors to me, to look at the patents and make sure those are novel and unique. And we look at the management teams and the opportunities, the market research and the products, talk to customers and partners and make sure these are strong opportunities before moving forward. The investments come from all over. I mentioned my VC roundtable, which is now in its 12th year. Our February luncheon will be on Wednesday at lunch here in San Diego. It's for investors, angels, institutional VCs, and corporate investors to talk about the companies they're looking at investing in for syndication and partnering purposes. And it's a great source of deal flow. We always have a venture capital fund presentation, so over 120 programs, that's over 120 venture capital firms that I've gotten inside looks of who, what, where, what types of deals they're funding, when did they close their last fund, which partners are investing in which types of deals and what stage and size of investment. And all that information is in my databases for those funds. So VCs, other VCs, entrepreneurs, CEOs, the top accounting and law firms all provide the deal flow for the opportunities that I invest in. And again, I target Southern California and underserved markets by venture capital. We only invest in the preferred equity rounds, typically A, B, and C rounds. We don't do seed investing, nor do we do bridge financings into the next rounds unless we've already made a preferred equity investment. And then upon distribution, upon exit through typically M&A or IPO, we would distribute the cash or stock in the company, in the companies that we've sold or taken public back to the LPs or investors in the fund. Immediately upon day of exit, 100% of the distribution goes back to the investors in the fund. And I'll mark to market the stock price if we sell a company to Qualcomm or to Amgen, for example. That stock price on that day of exit at close, and that will be done. The investors in the fund will decide if they want to hold Qualcomm stock or Amgen stock, for example. I won't make those decisions. The next slide is the investment areas. So I mentioned the diversified sectors, and we truly want to be diversified in both tech and IT and life sciences and healthcare. And so on the tech side, we're focused on data center and storing that data, securing that data, cloud-based companies and enterprise software and platform migrations, mobile and wireless, digital media, niche e-commerce and social networking and apps. And then on the clean tech side, smart grid-related and energy storage companies. And then under life sciences, we're more focused on med devices, products, and diagnostics than anything else. But we do look at drug discovery and biopharma, although they're very risky and take an enormous amount of capital and time. We are interested in niche opportunities there, and personal health and wireless sensors and so forth also are an area of strength for San Diego as well. So my background, I have a BS in engineering, material science and engineering from University of Florida, and MBA from University of San Diego. And I'm the founder of the VC Roundtable I mentioned back in 2002. I've been part of one in Silicon Valley that met in the late 90s and have continued to develop my relationships with the top funds in Silicon Valley through regular trips and meetings and transactions, investing, partnering, and syndicating with those top funds. But prior to this fund, I was the founder and developed and former executive director of the Morrison Foerster Venture Network, where I qualified our clients and helped them raise capital, which is really where the model for More Venture Partners came from, this blind pool of capital I have with 22 investors currently in the current fund. I'm a former managing director of a tech medtech fund in the mid-2000s called Hamilton Tech Capital, and prior to that I was an angel investor through a pledge fund called Acadia Ventures, and personally back to the late 90s. I'm an operator. I've been a CEO of a number of companies and had 2 successful exits, and also a research scientist and have developed the world's greatest thermal barrier control coatings for a company in La Jolla called General Atomics, among with a number of other technology programs that I ran in the advanced technology group there as a engineer and scientist, project and program manager, and marketing executive. My advisory board on the next slide is very senior and very world class. Bob Sullivan, the Dean of the Rady School here at UCSD, Dr. David Brenner, the Dean of the Medical School at UCSD and Vice Chancellor for Health Sciences, David Pike, the Dean of the Business School at USD, Nick Binkley, a former banker and has run 3 Bass Brothers funds, both venture capital. They did Stamps.com and another number of technology companies back in the 90s, and a more private equity today called Forrest Binkley and Brown. Nick's a former vice chairman of Bank of America. He's on the board of Union Bank of California today. And then Dwayne Townsend, the first venture capitalist in San Diego going back to 1982, over 30 years of investing through his Ventana funds, and my partner in my last fund, Hamilton Tech Capital. And then I rely on scientific and technical advisors on the next slide on a regular basis. So these 2 to 5 deals or companies that come across my computer every day, I rely on these scientific and technical advisors to help me with the preliminary screens and due diligence on these companies. So for example, Molly Holman, a PhD JD, is a former vice president of intellectual property at Amylin Pharmaceuticals. She looks at patents and makes sure they're strong and novel for me. Howard Tackett's an MD, MBA, former McKinsey consultant, and he also looks at life sciences projects and gives me, a feedback on the strength of those life sciences opportunities. Dan Caulfield co-founded and sold Tweet Photo to Lockers and is a software, IT, and social networking venture partner with my fund. Jack Kennedy was the former right-hand man for Rupert Murdoch at News Corp and Fox, and invested over $6 billion over 6 years for Rupert and Fox and News Corp and companies like Hulu and others, and is my digital media expert. And then Tarang Shah, an MBA, former SoftBank venture capitalist, more recently doing mobile payments and technology implementations for B of A, and has authored a book about a year ago called Venture Capitalists at Work, How They Identify and Build Billion-Dollar Businesses. And so these are also investors in my fund. The next slide are prospective investments. And with a venture capital fund, everybody wants to talk about types of deals, so I just threw some opportunities up here that are kind of the tip of the iceberg of opportunities that we're looking at. And one's a medical device, one's a therapeutic protein base for treating tumors in dogs, cats, and horses, Vet Therapeutics. Animetrics is a cloud-based data analysis company for marketing, real-time marketing purposes. And IPS Group is wireless chipsets that go on the parking meters, the single-head parking meters, so you're allowed to use your debit, credit cards, plastic cards to pay for your parking, growing very rapidly. The investment portfolio for the fund includes 4 companies at this time, and we're doing due diligence on our 5th investment at this time. Astute Medical is a diagnostics company the Wall Street Journal selected in November of 2012 as a top 10 healthcare company. They've developed protein-based biomarkers for diagnosing life-threatening conditions, starting with acute kidney injury and renal failure, followed with markers or tests for shock and sepsis and others. We invested in the B round with Domain and Delphi, 2 top-tier venture capital funds, and Johnson & Johnson Development Corp. And then we did 2 extensions in 2011 and in 2012, June, we invested in a C round with NPM, multi-billion-dollar fund out of the Valley, and Kaiser Permanente. And then, so we think this is a multi-billion-dollar type of opportunity. The founders of this company, Astute Medical, sold their last company, BioSite, to Inverness for $1.8 billion in 2007, and they're doing it again. So the chairman and CEO of BioSite, Kim Blickenstaff's chairman of the board, Ted Green, who created $6 billion plus companies here, starting with Hybridtech, is on the board of directors. So we've got an A++ board of directors and an A++ management team. Chris Hibbard, the VP of BD for Kim at BioSite, is the CEO, and the VP of R&D, Dr. Paul McPherson, is also the VP of R&D with Astute Medical. And interesting, Paul went to work for Inverness after a few years, or after a few weeks, realized that he wanted to start a new company to do this again, and that's exactly what they did in 2007 with Astute Medical. I helped them through the Morrison Forster Venture Network raise a Series A round in Q2 of 2008 and the Series B round of $26.5 million in May of 2010. And of course, we did the C round in June of 2012. And so we're off to the races. Their test results are out last week. They look extremely great, extremely well for a huge trial. So they'll be getting FDA approval this year and launching their tests in the U.S. this year. They began selling those tests in Europe last year. Daylight Solutions, I led the A round at $6 million in June of 2006. It's a laser company in San Diego. A Stanford PhD, Dr. Tim Day, hence the name Daylight Solutions, has developed for the first time in the history of the world tunable mid-IR spectrum quantum cascade lasers that now operate at room temperature in that 3 to 14 micron spectrum. And so the Pentagon found out about the technology and began ordering with purchase orders directly to Daylight by the caseload for these lasers for aircraft protection. Northrop Grumman has been rumbling about acquiring the technology, and we invested with them. They led a C round in July of 2011 with $10 million, and we invested with Northrop for the defense and military applications. There's medical diagnostic, scientific, and environmental. It's a molecular diagnostics capability of detecting compounds in that mid-IR spectrum down to the parts per billion level, allow the platform laser technology, which they manufacture, to be applicable across a number of vertical applications or markets. And so we'll have multiple exits, defense and military and medical diagnostics for over 200 disease states in the handheld portable device state that can be diagnosed in the doctor's office, environmental, scientific, and other applications. EcoATM, we invested with Coinstar in January of 2012, a little over a year ago. These are automated kiosks for recycling cell phones and portable electronics. Coinstar is very excited about these automated kiosks because they fit well with their Coinstar piggy bank machines and their Redbox machines, the dollar movie rental machines that they acquired in 2009. So we think we'll have an early exit of EcoATM to Coinstar, or someone much bigger like a Walmart or Costco will have to acquire them in a few years. And then one of the co-founders of Active.com here in San Diego, a triathlete, former owner of Triathlete Magazine, Mitch Thrower, created a cloud-based company for membership and loyalty with the hook of patents for scanning license plates automatically. And so Bump Networks, we invested with Eric Schmidt and his fund Tomorrow Ventures in a Series A round last fall in October. And we're excited about the prospects of Bump Network and contracts with Rick Caruso and the Grove and others to port their membership databases and credit cards onto Bump's cloud-based network for loyalty and membership and hundreds of partners that they've got on board. So we have a diagnostics, a laser company, an e-cycling company through automated kiosks, and a cloud-based software company in the portfolio already. And these next slide is the select VC fund relationships. These are all funds we've invested with, or I talk to and meet with and share deals with on a regular basis. These are all top funds, and they have all raised funds recently and have capital to invest and are excited about the projects that More Venture Partners is bringing to them. So at this point, we've got a number of limited partners. We've got 21 individuals. We've got one family office, and we've got a number of foundations and corporate investors we're talking to close out this fund on April 9th. And so the funds are callable. So, for example, if someone invests in the fund, I don't call all the capital on day one. I only call a percentage of the committed capital to make a number of investments, 1 or 2 investments that are about to close. We have enough capital in the bank now to make 1 or 2 investments, and later this year I'll call another percent, 10 or 15% of committed capital to make additional investments out of the fund. So we're in year 2 of the fund, and we're excited about the prospects of 4 great world beater deals in the portfolio and making another half a dozen or so more investments out of this fund before we go raise our next fund. So this fund model of a small fund, we're a $10 million fund that invests several hundred thousand up to $500,000 to $1 million per company, allows us to continue my great track record of investing and to fund our top companies by bringing the top tier institutional VCs and top corporate investors to our top companies and co-investing. So we're syndicate partners, and we help bring the lead investors to our companies. And this is an interesting model for the current time where it's nearly impossible to raise a full-size fund, particularly a first-time fund, but allows me to grow through increasing larger fund sizes, a full-size fund here in San Diego and Southern California, to lead or co-lead with the exact same top-tier VC funds, companies in those subsequent funds. And so that's the vision and goal I have, is to rebuild venture here in Southern California to lead those top investments with the top-tier VCs and corporate investors. So I have a great background from being an engineer and scientist and operator, CEO of a number of companies, and angel and venture capitalist with a great track record for making this fund and future funds a great success. And I'm excited about being in the market and helping fund the next most successful companies. At this time, I'll take questions.
Okay, thanks, Terry, for that very informative presentation. So one question we have from the audience has to do with overhang. And it's a comment and a question. And the comment is that the issue of overhang has been around for years, and it's usually been a very large number. Don't we still net today have an overhang instead of an underhang?
Well, people refer to an overhang of, capital, too much capital out there, that there's too much debt and so forth, and the restructuring of balance sheets and so forth with corporations is different than the underhang that I'm referring to for venture capital, where venture capitalists, those funds, venture capital funds, have invested far more capital than they've raised. So this is a real issue, because you can't invest more capital than you've actually raised for very long before you hit a wall. And so that's what I'm referring to here, is this problem of too much capital being invested, far more, approximately approaching $30 billion, has been invested than has been raised, which you really can't do for very long. And so this is what has to be addressed by either increasing amounts of funds being raised by venture capitalists, or fewer deals being done, so less dollars going into those investments. So I think some combination of those will occur as we go forward.
Okay, thanks, Terry. And this is a question for me. One of the things I always think about whenever I hear about new fund models and the outlook for any kind of capital is how the new changes in crowdfunding laws are going to affect the market. And I suspect, Terry, you've probably got some thoughts on that yourself.
Absolutely, Roger. It's a great question. We're seeing a number of companies fund product development and able to gain insight onto market traction and so forth on Kickstarter and others for crowdfunding. And this is an exciting time where companies are able to do that. We talked about, the reduction in the amount of seed capital that's available for, our startup companies. So crowdfunding does provide, access to capital to allow these startup companies to get product developed and to get into the market, which is what they sorely need. So I'm all for it, and as well as the number of incubators and accelerators that are coming onto the scene, which is always positive. We'll see more companies come through those incubators and accelerators, which allows us to have a greater pool of opportunities to invest in as venture capitalists at the appropriate stage. So I'm all for it. I think it's an exciting time, and the appropriate structures have to be developed, and there's a number of companies and models that will help those crowdfunded companies structure properly from a legal perspective, but make them exciting and interesting for institutional VCs to be able to fund and follow on rounds.
Okay. Here's another one. It seems that there has been a trend in recent years for fund sizes to come way down and be much smaller funds where the management fees are less significant. It's really you're much more of a partner, aren't you? Because you're much more dependent on the carried interest and other participation. But you seem to be bucking the trend a little bit in that your fund is not targeted on any specific industry or sector. Is that true? Is the trend now for funds to be one thing, maybe a clean tech or a life sciences or a mobile, or are more of the smaller funds like you?
That's an interesting question, and a lot of funds focus, and it makes a lot of sense for them. As I traveled the world and met with institutional LPs back in the mid-2000s, I surveyed over 550 LPs, and many of those LPs like a diversified fund structure. Some like to do their own diversification, and they like focus funds, but others like the diversification. And if you think about San Diego and Southern California, where I focus for my deal flow, a predominant amount of that deal flow, those are really the two industries that are very, very large and very innovative here in San Diego and Southern California. So we like the fact that we can cherry pick the very best deals from a diversified number of sectors. It makes a lot of sense, as I mentioned earlier, at time of exit, so that we have life sciences funds now that, geez, they're in their 7th, 8th year of the fund, and because life sciences has been down, biotech has been down as an industry for years now, going on 5 years or so. Those funds haven't been able to exit their portfolio companies, and they haven't been able to raise new funds. So for me, the reason why I'm doing this isn't just to have one small fund. That's not interesting, but to create a series of funds. And the only way you can do that is to have strong exits. And if I have to wait 5 years for a sector to rebound because I'm so narrowly focused that that's my sector, it just wouldn't work. So I think it makes a lot of sense for LPs that like a de-risk model of being diversified and across sector as well. So early growth and expansion, where we'll have some early exits. We're not waiting to year 7, 8, 9, 10 of the fund for exits, but we can actually have an exit of a majority of the portfolio in 3 to 5 years, which is, I think, an investment time horizon that most investors I know I have. I'm happy to exit a majority of the companies in a 3 to 5 year time frame because many of these companies have been around for a number of years, 4, 5, 6, 7 years, and they're that much closer to an exit than when you invest in a startup company that might take 8 to 10 years for real value creation.
And related to that, and this is the last question, is I've heard a lot about this Series A crunch. Are you seeing a Series A crunch out there in the market yourself?
Yes and no. The Series A, it's hard to find that lead investor, and that's what's unique about what we do. Early stage investors are somewhat unique, and after the last several years, the venture capitalists went to later stage and investing, and that trend to go away from taking risks. And so, what is really a Series A round? Well, hopefully the company has raised some friends and family capital. They've raised a seed round or an angel round, and they've got the product developed. They may have gotten into the market and have some early sales. They may have a partnership or two. And so that's the stage where we like to get involved. I look at earlier deals and at the seed stage, and we're happy to help those companies that we like as well. But the Series A, those Series A investors are special that lead those rounds. And as I mentioned, we've gone from 1,000 venture capital funds to about half that many. So the number of early stage investors has dropped dramatically as well. And that's the challenge, is finding those Series A round lead investors. And that's what More Venture Partners does. We'll help you bring that lead investor to the table and co-invest. And I think that's rather unique, just due to the depth and strength and breadth of the relationships I've built over many, many years with the top tier VC funds. And so, yes, I think it is a challenge to raise those Series A rounds. And as capitals continue to be constrained, it will continue to be a challenge.
So Terry, if somebody wants to contact you or maybe present their executive summary or business plan, what's the best way to get a hold of you?
That's on the for more information slide on the last slide of my presentation today. The contact information, Terry at MoreVP is the best way to reach me, and so I would suggest sending in an executive summary. And I have 2 interns that do the preliminary due diligence, preliminary screening, as well as the half a dozen or so technical and scientific advisors that I rely on a regular basis every week to help me screen those opportunities. And so that's the best way to get a hold of me.
Okay. Thank you very much, Terry. Very informative presentation. With that, we're going to conclude. I'd like to remind everybody that this webinar has been recorded and it will be available for replay both on the Royce Law Firm YouTube site as well as royceuniversity.com under webinars. Our next webinar is going to be on sustainability and socially responsible investing. That'll be interesting. That will be scheduled very shortly. So once again, thank you, Terry, and we'll go ahead and conclude now.
Thank you.